The deep dive is back, and our mission today is to really cut through the noise of what has been a pretty chaotic week in the economy.
Absolutely.
We're not just looking at a few numbers. We're staring down a data explosion, a whole stack of critical U.S. reports, the ones delayed by the government shutdown. They're all hitting the market at once.
And it's a moment of, I'd say, maximum tension. This deluge of information is landing on a market that's already deeply divided.
Divided how?
Well, you have one side that's just soaring, completely fueled by what everyone's now calling the AI gigacycle. And then you have the other side sinking under the weight of a fundamental oversupply in key commodities like oil. It's almost like two separate economies are operating at the same time.
Exactly. So for you, the listener, we're going to provide that crucial shortcut to understanding the fault lines here, the ones defining policy and all this market volatility. We've got 3 deep dives lined up. First, that high-stakes U.S. jobs report and why its headline number is, well, dangerously misleading. Second, the really crucial internal policy debate at the Fed about what is actually driving inflation.
And finally, that extreme split in the stock market. I mean, trillion-dollar AI valuations standing right next to multi-year lows in the oil sector. It's a wild scene.
Ready to jump in?
Let's do it.
Okay, let's start at the source of all the stress, that U.S. labor report. It's scheduled for Tuesday, and it's a combined snapshot of October and November. This is usually a pretty straightforward report, but why is this one so complicated for everyone?
It's a data trap, honestly. Because the government shutdown stopped the Bureau of Labor Statistics from finishing its household survey, the October report was just canceled.
Canceled completely.
Effectively, yeah. So now we're getting 2 months of impact crammed into a single release, and the headline unemployment rate is going to be completely distorted.
Okay, distorted how? I mean, if the economy is slowing down, shouldn't joblessness be rising anyway?
It will rise, but for an artificial reason, an administrative one.
Right.
We expect the official unemployment rate to spike pretty sharply. Forecasts are putting it somewhere near 4.5, maybe even 4.7%.
Wow, that looks alarming compared to September's 4.4.
It does. But that spike is what we call a statistical measurement artifact.
Tell me more about this artifact.
It's actually pretty simple. All those federal employees who were furloughed during the shutdown, they're temporarily counted as unemployed in the survey for that specific reference week.
So it's a temporary blip that's going to disappear next month.
Exactly. It's just noise. It doesn't represent real structural unemployment. So any serious trader, any serious analyst is going to largely ignore that headline number.
Okay, so if we throw out the noisy headline rate, what are the 2 crucial signals that will actually move markets on Tuesday?
First is non-farm payrolls, the NFP number. The consensus is pretty modest, only about 50,000 net new jobs for November.
That's a huge slowdown from the 119,000 we saw in September.
A very sharp slowdown. Goldman Sachs is a little more optimistic at 55,000. But the second, and I'd argue the truly critical metric for the Fed, is average hourly earnings, AHE, wage growth.
And why is AHE the clearest signal, even more important than the total number of jobs?
Because the Fed is still fighting inflation. And persistent wage pressure is the clearest sign they have of an overly tight labor market.
I see.
We expect AHE to rise about 0.35% month over month. Annually, that's about 3.7%. If that number comes in hotter, say 0.4% or higher,
then the Fed gets nervous.
Very nervous.
Yeah.
It tells them the labor market is still too tight to get to their 2% inflation target, and that would immediately impact their thinking on interest rates.
And that brings us right to the policy tightrope. The market and the Fed are already, fundamentally at odds over the path of interest rates. This report is going to either fuel the market's optimism or prove the Fed's caution was right.
It's the biggest source of volatility right now. The trading floor, if you look at interest rate futures, is pricing in 2 additional rate cuts by September of 2026.
2 additional cuts.
Yes. But the Fed's own formal projection, that famous dot plot, it only signals 1 cut for the entire year of 2026.
That's a huge gap.
It is. So if NFP or wages come in stronger than expected, traders have to unwind those bets on extra rate cuts. And that means immediate sharp moves in bonds and stocks.
And you can already see this filtering down to the consumer, can't you?
Oh, absolutely. This is why the Fed is so hesitant. Layoffs are up 54% year over year.
And consumer confidence took a big hit. It fell, 6.8 points down to 88.7 in November.
Right. And the most telling detail in that data is the shift in spending habits. Our sources are noting that planned spending is moving toward, and I'm quoting here, cheap thrills and necessary services.
So away from the expensive stuff.
Exactly. For example, in November, healthcare, a total necessity, it suddenly jumped into the #2 spot for planned service spending, displacing streaming services. People are pulling back on extras.
And that focus on necessities, like rent and healthcare, that leads us straight into the big inflation debate happening inside the Federal Reserve right now. What's truly driving it and how much of it is just, noise from the past.
This is where the real intellectual battle is happening. We've heard a lot of talk blaming the pickup in core goods inflation on U.S. tariffs, but Federal Reserve Governor Miron has been very public with his skepticism about that.
So he doesn't think tariffs are the main story.
He argues they're not the dominant driver policymakers should be focused on.
What's his counter-argument? I mean, tariffs are at historic highs. Wouldn't they naturally feed into prices?
They absolutely raise costs, but Miron says they just don't explain the whole picture. He points to two big conflicts. First is the timing conflict.
The timing.
Yeah. If tariffs were the direct cause, you'd expect the price spike to look the same across all the major inflation gauges. But it doesn't. In the PCE data, the price pickup lines up with the tariffs. But in the CPI, the Consumer Price Index, the upturn actually started earlier.
Months before the tariffs were fully in place.
Exactly. The causality is messy.
So the data isn't clean enough to blame it all on trade policy. What's the second point?
International comparison. If U.S. tariffs were the main culprit, you'd expect U.S. goods inflation to be a huge outlier compared to other developed countries.
It's not.
It's not. U.S. goods inflation is running pretty similar to Canada and the U.K., a bit above the EU and actually below Mexico.
So it suggests it's a global issue, not just a U.S. one.
Precisely. It points to global supply chain pressures. And he argues that if you focus too much on tariffs, you might mistake a one-time price shock for persistent inflation and, well, keep policy too tight for too long.
That's a really interesting point. So if tariffs are a red herring, what does Miron think is the real thing keeping Fed policy so tight?
It's the statistical ghost of the past. Specifically, the shelter component of inflation, combined with how long it takes for policy to work.
Right, shelter. Rent and housing costs. They're a huge part of the inflation numbers, but they work on a delay.
A very significant delay. Miron suggests that shelter inflation today reflects the supply and demand imbalance from 2 to 4 years ago.
2 to 4 years.
Yes, think about that. The Fed's trying to make policy for 2027 based on data that's really telling them about the chaotic housing market of 2022.
So you're making policy for the future based on a rearview mirror. That seems incredibly risky.
It is. And he argues that keeping policy this tight because of these measurement artifacts risks destroying jobs today for a problem that might have already been solved.
So what happens when you strip out those artifacts?
Well, he makes a really compelling case. He points out that market-based core inflation, which takes out housing and imputed prices like, portfolio management fees, is already running below 2.3%.
That's basically at the Fed's 2% target.
It's within striking distance. It suggests the underlying inflation problem, once you get rid of the historical quirks, might be over.
Okay, let's jump from the Fed's dilemma to the stock market, which is showing this classic and extreme divergence. The Dow is holding up, but the NASDAQ is slumping. And the reason seems pretty simple. AI is just in a different universe.
It truly is a gigacycle, a structural, generational shift. Global semiconductor sales are projected to smash records. They're going to cross $800 billion in 2025.
After a 19% jump this year.
A whopping 19%. And AI is the single undisputed catalyst for all of it.
And this money isn't just going into, buying more GPUs. It's going into the actual physical infrastructure needed for these massive models.
Exactly right. Global capital expenditure, or CapEx, is estimated at $160 billion in 2025. And investors are pouring money into very specific technologies.
Not just GPUs?
Not just GPUs. Of course, there's a lot of money there, but also things like high bandwidth memory, HBM. HBM revenue is expected to surge by up to 70% in 2025.
Why is that so important?
Because the AI chips, they need extremely fast memory right next to them to function efficiently. You can't have a bottleneck.
And what about advanced packaging? We saw TSMC's CoWoS capacity mentioned. What is that?
CoWoS stands for chip on wafer on substrate. It's a way of stacking components vertically instead of side by side.
Like building a skyscraper instead of a ranch house.
Perfect analogy. It dramatically increases the speed and density of the chip. And TSMC's CoWoS capacity, which is essential for the most powerful AI chips, is expected to double to 70,000 wafers a month in 2025. It's a huge deal.
This kind of momentum creates, well, astronomical valuations. NVIDIA is leading the way. Market cap of $4.6 trillion.
Trillion. With a T. It's larger than the GDP of entire countries.
And it's not just the public companies. We're watching what could be history with this IPO news.
Elon Musk SpaceX. They're targeting what could be the largest IPO in history for mid to late 2026.
How big are we talking?
They're looking to raise $30 billion, which would value the company at about $1.5 trillion.
Wow. For context, that would blow past Saudi Aramco's $29 billion raise in 2019.
Easily. And Musk's stake in that, his 42%, that accounts for over a quarter of his $470 billion fortune.
So that's the confidence side of the market. The
Yeah.
rockets, the chips, the exponential growth. But then we have the anxiety side, which is what's hitting the NASDAQ.
Yeah.
The fear of an AI bubble is very real.
The anxiety is really twofold. First, the cost of just doing business, M&A, is ballooning. Look at ServiceNow, the enterprise software giant. It plunged over 11% recently.
Why?
Well, partly because they're in talks to acquire Armis, a cybersecurity startup, for $7 billion. Analysts are worried they're just overpaying.
And the second anxiety is that AI isn't just a creator. It could be a destroyer for some business models.
Precisely. ServiceNow also got hit with an analyst downgrade, citing fears of seat count pressure.
Seat count pressure.
It means that generative AI tools are getting so good that companies might need fewer human workers, which means they'll buy fewer software subscriptions or seats in the future. AI could end up eating the subscription model from the inside out.
It's a market of just extreme contradictions. You have these multi-trillion-dollar empires being built, and then you have the Roomba maker, iRobot, plummeting over 70% after filing for bankruptcy.
It's hard to believe those two things can exist in the same market on the same day. A $1.5 trillion IPO target and a vacuum cleaner company going bust. That contrast is the story of this economy.
But even in the slumps, there were some bright spots.
There were. If you're tied to that AI roadmap, you showed strength. Tesla, for instance, jumped 4% on a Wedbush note, saying it could hit a $2 trillion market cap in the next year.
And that's all based on its autonomous and robotics plans.
Purely. The market is only rewarding the clear winners of this next tech cycle. Everyone else is getting left behind.
Let's pivot now to the other half of this bifurcated market. Commodities. While AI is soaring, oil is just hitting dramatic lows. WTI crude slated $56.60 a barrel. We haven't seen that since early 2021.
It feels counterintuitive, doesn't it, with all the global instability?
It really does.
But the fundamental reality is just oversupply. It's overwhelming every other factor. The International Energy Agency has been very clear. They see a persistent global supply glut. Global inventories are now at a 4-year high.
And where is all this extra oil coming from?
It's the non-OPEC plus players, the U.S., Brazil, Guyana. Their output just keeps reinforcing the expectation that production growth is going to outpace demand, probably well into 2026.
And the U.S. is leading that charge.
The U.S. in particular has maintained record production levels, just flooding the market. And at the same time, demand signals are weakening, especially from China.
Right. China's industrial activity is softer, and they're pushing hard on renewables.
Yes. And since China is the world's biggest oil importer, when they pull back, it sends a powerful bearish signal through the whole market.
This is what's so striking to me. We have major geopolitical turmoil, but oil prices are still sinking. Why aren't those risks creating a higher price floor?
Usually, geopolitical risk creates what's called a risk premium. Investors buy oil because they expect a disruption.
And we have plenty of risk. Ukrainian drone strikes on Russian refineries, the U.S. seizing a Venezuelan tanker, Iran seizing another tanker in the Gulf.
Major events. Any one of those in a different market could send prices soaring.
But the market just shrugs.
The market shrugs because the consensus view is that these risks, while serious, are not enough to significantly tighten global supply. They're seen as localized, maybe temporary, when compared to the persistent, fundamental, multi-year supply glut.
So for anyone with exposure to energy, the lesson is that geopolitical chaos just isn't enough to save you if the fundamentals are bad.
That's the takeaway.
Okay, what about a commodity that seems to be thriving on all this uncertainty? Gold. What's the outlook there?
Gold is in a really interesting position. It's showing a bullish setup precisely because of all this policy uncertainty. It has a dual catalyst.
How so?
Well, if the NFP jobs report comes in weak, that's a dovish signal. That means a weaker dollar, lower rates, and gold loves that. But if the NFP is surprisingly strong,
Then what?
Then gold trades on the policy error risk narrative, the idea that the Fed has tightened too much or will make a mistake. So either way.
So gold potentially benefits whether the news is good or bad for the economy.
That's right. Policy confusion is good for non-yielding assets. Analysts are watching for a potential push toward October's record high. The resistance zone is somewhere around that 43.80 level. If we step back and just connect all these dots, we're in a highly contradictory environment. We're seeing this extreme, almost fantastical confidence in one part of the economy.
Trillion-dollar AI valuations, historic IPO targets.
Right. And it's happening alongside this deep economic caution, falling consumer confidence, rising fears about job losses if the Fed makes a mistake.
And the policy struggle is still centered on that divergence. The market thinks the Fed will cut more than the Fed says it will. And the central bank's challenge is making decisions for 2027 based on data that's, well, years out of date.
It is. The economy is reacting instantly to news that crosses the wire today, but the Fed is guided by these long, lagging indicators.
It's a tough spot to be in.
Which really raises an important question for you, the listener, to mull over. The AI gigacycle is clearly intensifying the global talent war. It's driving these nationalistic manufacturing efforts with that huge $160 billion in capex for chips. So given the astronomical costs of advanced chip manufacturing, think of TSMC's CoWoS, and the severe global shortage of engineers, how will these structural hurdles ultimately reshape which nations and which tiny handful of companies truly control the next decade of technology?